What are the 5 important investing numbers you need to know now? Most investors don't lose money because they pick bad stocks. They lose money because they don't understand 5 basic numbers. Instead, they're drowning in charts, scrolling through opinions, listening to noise that sounds smart but means nothing. Price goes up, price goes down, and they have no idea why. Here's the truth. Successful investors don't track everything. They focus on a small set of numbers that actually tell the story of a business. If you don't know those numbers, you're guessing. And guessing with money is expensive. That's why in this video, I'm breaking down the 5 most important investing numbers you need to understand right now. No complicated math, no Wall Street jargon, just clear, practical explanations you can actually use. By the end of this video, you'll know exactly which numbers matter, which ones you can ignore, and how to use them to make smarter investing decisions with confidence. If you've ever felt confused looking at stocks or unsure why one investment is good and another is risky, this video is for you. Number 1. Rate of return. The first investing number you need to understand is your rate of return, specifically what your money is actually earning over time. In simple terms, your rate of return is the percentage gain or loss on your investment. If you invest $1,000 and it grows to $1,080 in a year, that's an 8% return. Now here's where most people get confused. There's a big difference between short-term returns and long-term average returns. Short-term returns bounce around. One year might be up 20%. The next year could be down 10%. And that's normal. Long-term average returns are what actually build wealth. Over decades, the market has historically rewarded consistency, not perfect timing. This is why trying to hit home runs usually backfires. Chasing huge gains increases risk and often leads to bigger losses. Here's the mistake to avoid: comparing yourself to social media investors. Most of those screenshots show wins, not losses. And many of them are taken at the top right before things fall apart. Focus on your plan, your timeline, and your average return over time. If you stay consistent and patient, the math works in your favor. That's how real investors win. Number 2. Expense ratio. The second investing number you must understand is the expense ratio, and this one quietly destroys more wealth than bad stock picks ever will. Your expense ratio is the annual fee you pay to own a fund. It might look tiny on paper, but over time, it adds up in a massive way. Let's make this real. Imagine 2 investors. Both invest $10,000 for 30 years. One pays an expense ratio of 0.03%. The other pays 1%. That 1% doesn't sound like much. But over 30 years, it can cost tens or even hundreds of thousands of dollars in lost growth. Why? Because fees don't just reduce your balance once, they compound against you every single year. This is where ETFs usually win. Most broad market ETFs have ultra-low fees, while many actively managed funds charge much higher ones and often don't outperform. Here's a simple rule of thumb you can remember forever. Lower fees mean higher long-term returns. You can't control the market. You can't control short-term performance, but you can control how much you pay. And over decades, that single number can be the difference between average results and serious wealth. Number 3. Diversification Score. The third investing number you need to understand is your diversification score, also known as asset allocation. In simple terms, diversification means not putting all your money in one place. It's spreading your investments across different asset stocks, bonds, industries, and sectors so one bad move doesn't wipe you out. Here's why this matters so much. When your portfolio is concentrated in just a few stocks or one sector, your risk skyrockets. If that area takes a hit, your entire portfolio feels the pain. Diversification acts like a shock absorber. When one part of your portfolio struggles, another part helps balance it out. For beginners, the concept doesn't need to be complicated. A simple mix of broad market stock ETFs, some bonds or bond funds, and exposure across multiple sectors is often enough to dramatically reduce risk. You don't need to predict which stock will win. You don't need perfect timing. The goal is to stay invested through ups and downs. That's the key message here. Diversification keeps you in the game. And staying in the game year after year is how real wealth is built. Number 4. Risk tolerance. The fourth investing number you need to understand is your risk tolerance. And this one is more emotional than mathematical. On paper, everyone thinks they can handle risk. But real risk shows up when the market drops 20 or 30%. And your account balance suddenly looks scary. This is where most investors get hurt. Not because their investments were bad, but because they panic sell. They lock in losses, miss the recovery, and permanently damage their returns. Here's a simple test you should ask yourself right now. If your portfolio dropped 20 to 30% tomorrow, would you stay calm or would you feel the urge to sell? Your honest answer matters. Risk tolerance isn't about being brave, it's about aligning your investments with your personality, time horizon, and emotional comfort. If your portfolio keeps you up at night, it's too risky no matter how good the returns look on paper. The smartest investors design portfolios they can stick with during bad markets, not just good ones. Because the best strategy in the world means nothing if you abandon it at the worst possible time. Know your risk tolerance. Respect it. That's how you stay invested and win over the long term. Number 5. Time horizon. The fifth and final investing number you need to understand is your time horizon. How long your money can stay invested before you need it. This is the difference between short-term and long-term investing. Short-term money like cash you'll need in the next few years shouldn't be exposed to big market swings, while long-term money can ride out volatility and grow. Here's why time is your ultimate advantage. When you stay invested long enough, compounding does the heavy lifting. Your money earns returns, then those returns earn returns, and over years and decades, the growth becomes exponential. This is why investors who start early or simply stay invested longer often outperform people who try to perfectly time the market. That leads to the most important message of this entire video. Time matters more than timing. You don't need perfect entries. You don't need to predict the next crash or rally. You need patience and consistency. The longer your time horizon, the more forgiving investing becomes, and the more powerful compounding works in your favor. Give your money time. That's how small, steady investments turn into serious wealth. What numbers don't matter? Now let's talk about the numbers that don't matter nearly as much as you think but get the most attention. Daily market moves. Red days, green days, headlines screaming panic or hype. These numbers create noise, not insight. The market moving up or down today tells you almost nothing about where it will be years from now. Yet most investors make emotional decisions based on short-term fluctuations they don't control. Then there are hot tips: a friend, a TikTok clip, a Reddit post promising the next big thing. These rarely come with context, risk management, or a long-term plan. Here's the truth. The more you watch daily movements, the more likely you are to overreact. And overreacting is one of the fastest ways to underperform. Great investors don't ignore information, they filter it. They focus on long-term numbers, not daily drama. By tuning out the noise, you reduce stress, avoid panic selling, and make clear decisions. Sometimes the smartest move in investing isn't doing more, it's paying attention to less. Let's bring all 5 numbers together with a real-world example. Imagine Sarah, she's 30 years old, works a regular job, and invests $300 a month into the market. First, she looks at her rate of return. She's not chasing massive gains, she's targeting steady, long-term growth and staying consistent. Next, she checks expense ratios. Instead of paying high fees, she chooses low-cost ETFs so more of her money actually works for her. Then comes diversification. Her investments are spread across different companies and sectors, so one bad stock doesn't derail her entire plan. She also understands her risk tolerance. When the market drops 20%, she doesn't panic because she expected volatility and invested accordingly. Finally, her time horizon keeps her calm. She's investing for 20 to 30 years, not 20 to 30 days. Because she follows these 5 numbers, Sarah doesn't overthink. She stays disciplined. And over time, that discipline compounds into real wealth. That's how smart investing actually works: simple, patient, and intentional. Here's what it all comes down to. If you master these 5 numbers, investing becomes boring, and boring is profitable. You're not refreshing your portfolio every hour. You're not chasing trends or panicking over headlines. You're just following a simple plan based on numbers that actually matter. Rate of return, expense ratio, diversification, risk tolerance, time horizon, that's it. These 5 numbers give you clarity when everyone else is confused. They give you confidence when the market gets messy. And they give you control over the one thing that actually determines your financial future: your own behavior. Most people overcomplicate investing because they think complexity equals success. But the truth is simpler. Understand these 5 numbers, apply them consistently, and let time do the rest. That's how everyday investors build serious wealth, not through luck, not through secrets, through clarity, discipline, and patience. If this video helps simplify investing for you, hit that like button. It helps more people find this content. Subscribe to Finance Flash for more no-nonsense finance advice that cuts through the noise. And drop a comment below. Which of these 5 investing numbers surprised you most? Or which one do you want to learn more about? I read every comment, and your feedback helps shape future videos. Thanks for watching, and remember, investing doesn't have to be complicated to be powerful. Stay consistent, stay patient, and I'll see you in the next one.